If you've been investing in mutual funds as part of your retirement portfolio, pay close attention to what I'm about to share with you. The information I'm going to share in the next 60 seconds could mean the difference between running out of money in retirement or perhaps maybe taking that vacation you've always dreamed of if you manage your nest egg properly. I'm going to share with you some very important nuggets of wisdom with you on how to decrease your investment fees and reduce the volatility your portfolio is experiencing and potentially increase growth in your portfolio at the same time. Too many people's portfolios simply do not achieve the returns the stock market does, not even close. When you hear the news stations talking about the stock market, they are typically referring to the S&P 500, which has a track record of beating 91% of all actively managed mutual funds for many decades now. And mutual funds are currently the most popular stock market investment vehicle, but that landscape is changing very fast. It is my belief that after viewing this video, you will have wished you'd seen this a long time ago, but it's not too late either. The concepts that I will share with you are not necessarily new, but because they are very cost and tax efficient, it is hard to compete with them using the old-fashioned way of investing like many investors are doing today. I call it financial planning 2.0. Most of the big fund companies don't want you to know about this because it pretty much cuts them out of the picture. The fund companies want you to keep paying them the high fees, which is why you haven't seen many investment firms advertise this type of investing in the past. However, the writing is clearly on the wall with the big fund companies. Adapt to the more sophisticated investor today. When you've completed watching the short video, you will know how to properly navigate the unpredictable markets, and realizing the timing the markets is nearly impossible, but navigating the markets is very doable. You will also learn the benefit from working with a fiduciary investment advisor representative who is required to put your interests ahead of their own. The old style way of using a financial professional who's not a fiduciary is that they would sell you a commissionable product, which may have been a good investment, but you always have to ask the question, whose best interest was in mind that led to that investment in your portfolio? Was it yours or the financial professional who earned the commission on that product in your portfolio? Hi, my name is Michael Hass, and I've helped hundreds of retirees in or near retirement pursue their goals of living the lifestyle they've always worked towards and dreamed about. Acting as a fiduciary, I do not earn any commissions at all. Instead, I manage my clients' assets in a fee-based relationship. So when you do better, I do better. It's a win-win for everybody involved. If you'd like to talk about how this information is going to affect you during your retirement, please click the button below to set up a time for us to talk. Here are some of the problems impacting some mutual funds. There are additional costs over and above the management fee that is disclosed. They do not permit intraday trading, meaning they cannot be bought or sold during the business day. It can also be very difficult to develop a portfolio with no overlapping securities. They are not very transparent, in meaning the fund's holdings are not easily viewed on a daily basis. And for non-retirement accounts, they can be very tax inefficient, causing a nightmare when you have to pay taxes in your portfolio that lost in the previous year. So let's take a closer look at these 5 mutual fund problems in more detail. The first problem is cost. According to an article written by Ty Bernicki and printed in Forbes magazine, the average actively managed mutual fund expense ratio cost is between 0.9 and 1.2%, but the article cites additional costs to the managed mutual fund. The average transactional cost is 1.44%. That's $1,440 for every $100,000 you have invested annually. The average tax cost for non-qualified accounts is 1 to 1.2%. That's $1,000 to $1,200 for every $100,000 you have invested annually. Cash drag is about 0.83%, which is money in your fund sitting in cash for future potential stock purchases. That's $830 for every $100,000 you have invested annually. Soft dollar cost, 40% of all trading costs. This cost comes into play when mutual fund managers are buying and selling stocks within the mutual fund's brokerage accounts. Frequently, mutual fund managers may direct the money being managed to brokerage companies providing them with research and/or other services, even if the brokerage companies are not providing the most cost-efficient brokerage commissions involved with buying and selling stocks. Essentially, this is a quid pro quo arrangement. The mutual fund manager gets special services and or research, and the brokerage company gets the brokerage business at a premium rate. This effectively keeps the cost out of the public's eyes, giving the fund an artificial appearance of lower than actual expenses. A research study by Stephen M. Horan suggests that U.S. soft dollar brokerage commissions may total $1 billion annually, or up to 40% of all equity trading costs. If you add these up, the total cost for an actively managed mutual fund for non-taxable account adds up to 3.17% and 4.17% for every $100,000 you have invested annually. There's also a book titled The Great Mutual Fund Trap that was written by two gentlemen that retired from the U.S. Department of Treasury, Gary Gensler and Gregory Baird. Those authors put these costs at 3.4% and 4.3% annually. That's $4,300 for every $100,000 you have invested annually. And according to an article written by Bob Pisani and printed on CNBC website, for 9 consecutive years, the majority of large cap funds have lagged the performance of the S&P 500. And over the last 10 years, 85% of all actively managed large cap funds underperformed the S&P 500. And after 15 years, nearly 92% trailed the S&P 500 index. So according to these credible sources, when you think about it, these actively managed mutual fund managers have to outperform the S&P 500 index by 3.4% just to give you the same performance of the index. That seems to be too difficult of a task to overcome for them, which is why 92% of them can't do it. So why bother using actively managed mutual funds? Secondly, another big problem of mutual funds is that they are not tradable throughout the current market day as other instruments are. Let's say you're reading the paper over the weekend and you believe that come Monday morning, the market is going to start some sort of long-term slide because some geopolitical event has happened over the weekend, and that you are convinced that the market is going to have some kind of correction. So you call the custodian of your investment account on Monday morning at 9 a.m. and put in an order to liquidate some or all of your mutual funds. Your advisor puts in the order to sell them, and like every mutual fund in the country, that transaction will be facilitated at the end of the business day, after the market closes. So, should you have been right, and the market did slide as you expected, even though you had the foresight to get out of the market, you would have absorbed the losses all that day. I'm not saying you should try to time the market's highs and lows, but using investment vehicles that are tradable throughout the day can provide you confidence in knowing that you are not stuck in volatile markets. The third problem with traditional mutual funds is that they have lots of something called stock overlap. We've all known since the beginning of time that you should never put all your eggs in one basket. So we have, as investors, do the smart thing by putting your money into several different mutual funds so that you have different holdings. Well, there is software that allows me to simply input a portfolio and it generates an investment account analysis, and a section in that report is called Stock Intersection Report. It looks at the holdings of your different mutual funds, and what we found is that most people's mutual funds wind up buying a lot of the same stocks, so you're not as diversified as you think you are. This Stock Intersection Report shows in this portfolio the top holding in the account is Microsoft, which is owned by 7 different mutual funds in this investor's portfolio, when we should only see one mutual fund holding any given stock. The second stock is Amazon, and that stock is owned by 5 different mutual funds in this investor's portfolio. Again, only one mutual fund should own any particular stock, which is why we chose different mutual funds to begin with. And you can see the overlap continues on and on with all the other holdings in the investor's portfolio. I actually had one gentleman come to my office a couple of years ago, and he sits down with me and he says, "Michael, my portfolio is very well diversified into 10 different mutual funds. I feel good about it, and I believe I'm all set." Well, after we ran the analysis on his portfolio with the software, we found out in his case that all 10 mutual funds bought many of the same stocks that the other funds did from beginning to end. What a mess. If I were to use that same software and spent many hours trying to build a portfolio of mutual funds with very little stock overlap, that portfolio changes the very next day anyways because of all the buying and selling activity of managed mutual funds. Plus, this leads me to the next problem of mutual funds. The fourth problem with traditional mutual funds is that some are not very transparent. What I mean is that when we attempt to look inside a mutual fund to see its holdings, which could be as many as 200 different stocks, the best data that mutual fund may show us is their top 50 holdings only. Plus, this information may be only updated once every 3 months, and they may not show us what they own today. So how are you supposed to develop a portfolio when you're attempting to position your nest egg into a portfolio when you are looking at 3-month-old data? So as the Dalai Lama once said, a lack of transparency results in distrust and a deep sense of insecurity. So without transparency, there's less accountability. The fifth problem with traditional mutual funds is that they are a tax nightmare for non-retirement accounts anyways. For those investors that hold mutual funds and non-retirement accounts in years where your portfolio may have experienced a loss, such as in 2008, where a $100,000 portfolio invested in the S&P 500 lost $37,000 just in that fiscal year alone. Don't forget, the S&P 500 outperforms 80% of all actively managed mutual funds, so they did even worse. And those investors that held their mutual funds and non-IRA accounts, in addition to watching their portfolios lose money, which can happen in any given year, they were very likely to receive a 1099 from the mutual funds they were holding. This is because of something called capital gain distributions, which most mutual funds distribute to its shareholders in December of each year. You may not have sold any of your mutual funds that year, but there's been lots of buying and selling inside the mutual funds by the fund manager, which creates those capital gain distributions that the fund manager then passes on to you at the end of the year, which generates a 1099 come the following January. That means they also had to pay taxes on that portfolio as well. That's adding insult to injury. Another problem with mutual funds deals with the risk versus reward. We use software that analyzes a portfolio's risk-reward relationship. So many times we find out that your portfolio has more risk than the stock market, but often generates less returns than the stock market does. So then we ask the question, if your portfolio has more risk than the stock market, shouldn't your portfolio be getting better returns than the stock market? Seems logical, doesn't it? Or perhaps you are conservative and you don't want more returns than the stock market could provide. Then certainly you should have less risk than the stock market has. Makes sense, doesn't it? We can precisely discover your individual risk tolerance through a discussion with you about your feelings of various different market conditions, when you expect to withdraw from your portfolio, and how long you anticipate living during retirement, all while planning for the possibility that you could outlive your own expectations. This will allow us to know exactly how conservative, moderate, or aggressive your portfolio needs to be. What I can do for you is to show you how to help mitigate the costly mistakes that many investors make today by showing you how to develop a properly managed portfolio using lower cost, more transparent, more liquid, and more tax-efficient investment vehicles with little to no stock overlap. Now, you could just attempt to fix your mutual fund portfolio today and replace them with some other investment vehicles that you might choose and think your problem could be solved. Or you could use my experience to help you develop a portfolio that may provide the increasing income that you will need all throughout your retirement years. And there's always room for some adjustments in your retirement nest egg from time to time. I'm not talking about constantly moving your entire portfolio around, but making some minor changes from time to time, which doing it may reduce your overall risk and volatility and potentially enhance your portfolio's returns. So at this point, you have two options. You can continue to handle things on your own and hope and pray for a good result at the end. However, hope and prayer, not a good retirement strategy. Or you can work with a fiduciary investment advisor representative such as myself, who has helped hundreds of retirees live out the lifestyle they've always planned for. If you have $250,000 or more in your portfolio and you'd like to have a professional develop and manage your portfolio, and you'd like to reduce the risk in your nest egg while potentially enhancing your portfolio's returns, then we could be a good fit together. If you're simply looking for more information and you want to handle things yourself, then I do wish you well, And hopefully you can implement many of the concepts I talked about today to improve your own situation. I work with retirees who are in or near retirement to address their concerns about retirement by implementing established investment management strategies so they can pursue the retirement lifestyle they've always strived for. I'd like to invite you to schedule a complimentary one-on-one consultation. Here's why this may be worth your time and what you should expect. At the completion of your consultation, you will have learned number one, how much money you can save by utilizing lower cost investment vehicles. For some clients, this has meant thousands of dollars per year back into their pockets. Number two, how diversified your portfolio currently is and how it should perform during market corrections. Number three, how much risk you are exposed to in the market versus how much risk you are comfortable with. Number four, the appropriate amount of risk in your portfolio for the reward that you are striving for. And number five, how to construct your portfolio so that it is very tax efficient. After you've scheduled your consultation, I will call you on the phone or Zoom meeting, if you desire, at the time that you have requested to discuss your concerns about your retirement. The initial consultation will last about 30 minutes. I look forward to speaking with you. Please click the button below to book your consultation with me today.